Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Today's guest is Kathryn Kaminski, Chief Research Strategist at AlphaSimplex, where she's also co-portfolio manager for the firm's managed futures strategy, global alternative strategy. She also co-authored the book, Trend Following with Managed Futures, The Search for Crisis Alpha. It's not her first time on the show. She was first on back in May 2021, episode 310. You can check the notes in the show notes for the link. Katie, welcome back to the show.
Thanks for having me. Fun to be here.
I almost feel like, other than gold going to 10 zillion, this is almost a little bit of like a glass half empty. I heard the other day, someone always talks about glass half empty, half full. And they said, my glass is refillable. I said, that's a good way to think about it. But talking about managed futures this past year, maybe a little bit better last few months, but it went through a rough patch. Let's just get it out of the way early. What happened? What's going on in our trend following world?
I think the thing is, we have to acknowledge that we experienced what would be sort of a massive shock to markets on Liberation Day, which basically was a precursor to the markets that things are changing. Trade policy is going to change, diplomatic relations are changing, everything's changing. And the markets really just went crazy, right? And so in that environment, the real macro change is coming, but it's more just like, what does it mean? And I think when you're dealing with a technical strategy, that is sort of your Armageddon. It's just massive moves, lack of direction, reversals, panic. And so I think for us, those are what I call turbulence days, where basically you have coordinated market sell-offs, you have a lot of vol, you don't have trend, but eventually the trends come back. And so that is sort of how I think about what's happened this year. The shock and then the aftershocks.
All right. What's the premier index? Is it SocGen? Is that the one we all talk about?
Yeah, the SocGen CTA and the SocGen Trend Index are the most commonly cited examples to understand how managed futures and or trend following is performing. And most investors, the challenge with them, of course, they're non-investable. They are indices of different managers. So they kind of represent the sort of typical experience of a typical trend following or managed futures investor.
And I say that, and we'll put some links in the show notes, is that it went through one of the larger, maybe largest, I don't know, kind of drawdown or underperformance periods earlier this year. Am I getting that right? And this caused you to write a paper, which I love it when people don't shy from when something's struggling and say, hey, look, let's take a look at this. Why is this doing this? What's the story?
Yeah, I mean, I'm funny like that. Anytime something wild happens in the markets, it's so easy to kind of feel the energy of that day. So I'm sort of a data nerd person. So I'll always go back and say, let's look at the data. What has happened in the past? What kind of patterns have we seen? And how is this similar or different to historical data? And so we wrote this particular paper that you're mentioning, which is called Market Cycles and Managed Futures Drawdowns, to kind of analyze the profile of drawdowns for managed futures over history of that index, and to try and understand sort of how common these type of drawdowns are. And actually, this drawdown was the second worst since the history of the index. But, it was kind of giving some perspective that it is in a group of different periods which have been challenging.
What was worse? Do we remember off the top of our head?
Yes, I do. It's actually the longest one, and the deepest was Trade War 1.0. So that was from 2019 to 2021. So a little bit around the time we were talking, I think we talked back in 2021. But as you know, drawdowns are often precursors to really big positive trend periods. And trend actually had one of its best periods following that particular drawdown in 2022, where, this short bond trade just was pretty phenomenal. So I think it's just a question of kind of the cyclicality of these strategies.
In your paper, you talked about drawdowns. And is it something that we can tease out with equities? Like, do they traditionally happen when equities doing great, poor, choppy?
This is a great question. And that's one of the interesting features of this particular paper that I found very interesting, because we often look at this problem the other direction, right? So we look at how does managed futures do when there's an equity drawdown? So instead, I was asking the question, what kind of environment for equities tends to be common during a drawdown, and what kind of environment is during the recovery periods for these particular events? Because of course, when I started writing this paper, it was when this event occurred, because I'm thinking what is the recovery? How long is it going to take? And what was interesting is I found that managed futures drawdowns often occur during good equity environments. So when things are actually pretty good for most investors in portfolios. And I know this year was stressful, but let's be honest, it's been pretty good for most equity investors right now. But what was more interesting is when managed futures tends to recover the quickest is when you actually have some drawdowns in the equity market. So turbulence and difficult periods are actually a recovery and positive period for managed futures. And that's kind of a well-known concept for managed futures, but it kind of shows that countercyclicality of the strategy compared to, say, equity portfolios.
I feel like that makes sense. I feel like that's the way one would kind of expect it to be. It'd be weird if it was the opposite or different. I remember reading old Tom Basso, old podcast alum guest who wrote a piece many moons ago, I think it was Tom, about investing in CTA managed futures trend during the drawdown periods, on how that was a great time to do it. Any other takeaways on can we predict any of these periods? Who was it? I remember talking to some trend followers years ago before, and they were talking about one of the drawdown periods. And they're like, it was one of those periods where you could just kind of feel it. Everything was going too good. Everything was cruising along, and just oh man, here we go. But anything we can do to kind of try to avoid these?
Unfortunately, no. I mean, they're so idiosyncratic. And what I noticed as well is the length of the drawdown period, and as well as the recovery. Oftentimes the recovery is faster, but not always. In terms of timing drawdowns for managed futures, it's also tricky because it's oftentimes a shock or a shift in the trend landscape that causes this, or an environment where trends are just not as prevalent. So for me, it's either back and forth movements, so markets that are really choppy is not good for managed futures, or sort of a shift in regime that we're sort of caught in the middle of that. So from my perspective, I generally suggest it's really difficult to time these strategies in general. The only thing I do suggest in general is this idea of rebalancing, right? So the best time to rebalance into a strategy is obviously when it's undervalued. And the best time to take profits in the strategy is actually when you've done really well. So that's something we've actually seen institutions do some of that.
Really? Good for them. Usually investors want to do the opposite.
Yeah. So meaning that in 2022, where the strategy was doing just knocking the lights out, you kind of readjust and re-up into equities and capture some of that re-up. And then in a period like right now, you're seeing institutions that recognize this strategy and actually allocate to managed futures when it's in a drawdown to rebalance. So I'm more about rebalancing than trying to say, hey, pick the tops and bottoms. That's tough.
I need to meet some of your investors.
If you're a person that nerdily, is doing this every day, you can kind of feel that the trend is not strong, and you kind of know that type of environment. Whereas right now, ever since the summer, it feels to me that the markets have kind of started to see through some of the headline risk and more be focused on fundamental change and fundamental drivers. And the truth is trend following is really about capturing those macro themes across different asset classes over time. And we had a massive shock, big changes in the geopolitical landscape, big changes in trade policy. All of these things will change fundamentals. But that needs to do it in a slow way, not in a shock way for us to be able to capture it. And we've started to see that.
What's the patience premium? Does that mean it's just like John Bogle trying to, say, hey, you buy this, you put it away, put it in your lockbox, you ignore the jiggles, or what's it mean to you?
Yeah. So, I think the patience premium is really more about a lot of these strategies tend to recover after drawdowns. And so you do get a premium in some sense. The argument of that particular article, which you're mentioning as well, that we also wrote, is really about sort of, if you have patience in a strategy that's like this, they tend to revert, they tend to be cyclical. And so there is a premium to being patient with strategies and not just picking, those at the bottom of the list and saying, okay, well, that doesn't work anymore. Instead, you're kind of saying, well, these things are cyclical and they'll come back with time.
As we think about mental accounting and how we bucket these investments, we've definitely seen friends, prior podcast guests like Eric Crittenden, Corey Hofstein, and others, they'll combine managed futures with other things like equities is a good example, and try to do a blend so that it gives people somewhat of a mix. Corey calls it return stacking, some call it capital efficiency, on and on. But it's a way of like putting your vegetables into the mac and cheese, I think, and managed futures, I guess, it's vegetables, even though they might be the mac and cheese in the recipe. I don't know. So when you talk to these institutions, and maybe not the ones that are well behaved, but just you're talking to people in general, and you're talking to them about allocating to managed futures in trend as a strategy, what do you kind of say about how they should think about it? Are you just like, look, it's strategic allocation, put it in 10 years, see you later, see you in 2035? What's some behavioral sort of Kahneman, Tversky sort of hacks that we can use to talk to these folks?
I definitely believe in sort of focusing on the strategic allocation and explaining that this is something that does well in periods which are very different from your traditional equity exposure. And I think, what I like with the equity plus trend strategies or anything that does a combination, I think it's an easier way for an investor to hold that exposure, and they have natural capital collateral. It's very collateral efficient to do that, for example. So you get your equity exposure and you can get your managed futures at the same time. Of course, you do dilute like that power impact of managed futures when you do have it with equities, but it does smooth the ride for an investor that wants some of that managed futures exposure without maybe taking it, full throttle, as one might say, because it is a strategy that is somewhat anti-correlated. I was just looking at the correlation of trend to equities over 25 years is slightly negative. And, if you believe in diversification, that is a strategy that's very interesting for your portfolio, but it can be hard to hold because it is different than equities.
I always tell people, I say, to me, trend is, in managed futures, is the premier diversifier to a traditional portfolio. I was like, I can't think of something that is as good when you want it and that it's not a huge cost. Tail risk type of ideas they're designed to do great when equities do poorly, but it's more of an insurance cost, where managed futures, to me, should have positive expectancy over time. And so you get that kind of non-correlation. It's funny, people always want the non-correlation when things puke, but when, stocks do good and something else isn't doing as good, they say, I don't want the non-correlation now. I want it to go up as well. So, but to me, it's still the premier diversifier.
Yeah, I think there are just very few things that are that different. And it's just philosophically a very different way to invest. And I think that is what we've all studied in, Finance 101, is you want something that's diversifying. But the truth is, as you pointed out, the behavioral aspects are very important.
I was telling my team actually today, I said, look, most U.S. investors are underallocated to real assets in general, but specifically with things like precious metals going through the roof recently, gold, silver, they're starting to generate some attention. And you all of a sudden have a whole cohort of people who are like, oh, well, my clients don't own any, or I don't own any, but I want some gold and silver exposure, but I'm nervous that I'm going to buy it and it's immediately going to go down 50% or something. And we often say to people, well, that's the beauty of having a trend following allocation, because now you get exposure to these type of assets and you have an exit, right? Like at some point you say, okay, well, it may not be this year, maybe when gold's at 10,000, 20,000, who knows? I don't know. But at some point you say, okay, enough's enough, I'm out. And historically, things like gold have done wonderful with trend following.
I just think that's a great example, that because the thing is that if you have an investment in something like managed futures, it's going to follow the prevailing trends in the market, whatever they are. And it's not about having a deep philosophical view about where the market is going and that you think X, Y, and Z is going to change. It's that you're following the prevailing themes as they develop, with a process to change over time that is dynamic, right? And so any investor who has managed futures right now is long gold, is long silver, but they know if those trends are changing, that those positions will adjust as well. So I think that's a really good proof point for, especially for the FX markets and for commodities. Those are assets and exposures that a lot of investors don't think about. And so it just gives you a way to have those exposures. For example, they may not be shorting the yen, which has been an interesting one as well lately. So it's really about sort of having that macro exposure without having to have any sort of view about, should I go buy bars of gold and put them at my house or whatever, or if I buy them, will they all go on sale, and I'll just totally, just have too much timing risk associated with those type of bubbles or those type of huge moves, really.
May have to hold out a little bit on booking my annual Japan ski trip. And, as the trend follower in me is looking at what's going on. I mean, the US dollar is down against a lot of pairs. That's also the beauty of FX listeners, is people love to talk about, is the dollar up, is the dollar down? And often say against what? There's dozens of pairs that probably are tradable, but even through the majors, the yen trading at 150 something currently as of this recording. There's just one FX market, which I think is a great point that you mentioned. So, all right, everyone's long gold, everyone's long silver. This is actually a good argument, I think, for talking about trend in general, because if you look back to a couple years ago, even if I told my Canadian and Aussie friends, hey, gold's over 4,000, they would be like, no way. Yes, we've been saying it's going to do that, and yes, we believe it, but also no way, right? I think it's you. Correct me. I'll attribute it to you if it's not. But I feel like you wrote about the fact that, trends, some of the best part of the returns is in kind of like the long end. It's not in the turn of the trend or in the beginning. It's kind of like once it extends. Is that you? Do I get the attribution right?
I'm not sure, but I definitely agree. Because the thing is, the hard part with any sort of trend is asking yourself the question, will it keep going? And I think if you start to ask that question, oftentimes the market can extend much farther than you can ever imagine. I mean, I think, for example, dollar, it's been down so much, and I keep getting questions like, could it go down more? And as a trend follower, you don't ask that question. You just stay in the diligent approach, and, you'll see prices move massively, sometimes much farther than we can figure out until after the fact. Then you realize like, oh, now I know why. But, during that trend, oftentimes it's hard to tell. I mean, I think my favorite story from being in the trend following space was 2014. So you remember when you had that big move in the oil markets where oil prices just went way down and way past fundamental valuation, even for macro traders. And what happened after the fact was we understood that the shale production in the US actually was overwhelming and messing up the dynamics in the oil market. But, during that trend, everybody was sitting around hypothesizing about like, oh, was this or this? It can't go any farther. But that's where you sort of have the biggest part of that particular trend, the profitability, is when they extend oftentimes to levels beyond our own comprehension, like gold right now, for example.
As we think about this, I think it's useful for investors of all walks of life and all strategies. The US stock market on a valuation basis, in my mind, is expensive. And, I always talk to people and they say, well, Meb, you say it's expensive and then it goes up, therefore you're wrong. And I was like, well, hold on. Like, this isn't a right or wrong comment. This is just, it could easily go from a P ratio on the 10-year of 40 to 60 or 80. Like, that's happened in other countries. Like, there's nothing, inherently stopping it from doing that. And so trying to be able to profit in. Same thing with gold. Like if you and I sit down again in a year or two, say, man, can you believe we were talking about gold at 4,000? Now it's at 8.
Oh my God.
That was crazy, or 10. But like, that's not out of the question in my mind. And same thing if it's back at 2, I would say, neither one of those to me sounds. I just told my brothers, we got a big sack of, what do you call them, the silver 50-cent pieces somewhere. I was like, you guys got to go take these down to the pawn shop. Let's go on a fishing trip. I think these have a better use somewhere else. But I think that's the beauty of this, is that each year I want to do a chart somewhere and come out with like the trend following trend of the year, which is like hey, this year was $0. This year it was short oil. This year it was long gold, whatever it may have been. But almost always the big profit comes from only a few trades often, right?
It depends. I mean, and sometimes it's these fun trades like cocoa last year, or, we were talking about the soy mocha latte, whatever trade that we were looking at last year too. So, it can be very different types of markets. I mean, it can be, anything from gold to yen to other different, I guess, trends in the more classic asset classes are a little bit more pervasive. So if you're thinking about bonds or stocks, but what's nice about trend following is you get that diversity of different trends that you can incorporate. I mean, I think this year, the fact that gold and equities are up at the same time, that's kind of a funny one. I mean, to me, it's a hedge.
Let's do a little review. Your Crisis Alpha book. Any thoughts as you look back on it, as we look forward? What can investors expect as they think about that book and all of its frameworks?
It's interesting you say this, because a CME group just hosted a seminar on Crisis Alpha last week where I was speaking at, and it was really fun to kind of talk about it because I've been in the space for a very long time. And, initially the whole concept of Crisis Alpha has morphed a little bit. So the initial definition of it was really Crisis Alpha are the opportunities that might be reachable or might be attainable during crisis. And my whole argument initially when I was studying these strategies, including long vol as another example of that, is that the goal is to try and capture Crisis Alpha. It's not a guarantee. It's something that we're looking for. And so I think over the course of the last, out of sample period for me, it has been very consistent. So, not exactly a hedge, but living through COVID, for example, and living through 2022 and watching this strategy perform as I would have expected and really sort of be able to adapt to that environment was very interesting to see. And then, of course, you see these environments like this where, you have turbulence and things are good in equities, but trends are tricky. So I think for me, looking back over many years in this space, I still think that Crisis Alpha is one of the main goals of managed futures. But I think one area that I have definitely adapted my view of the strategy is I think it's much more of a macro story. And crisis just happens to be a very extreme macro environment. So the strategy is really about following those macro themes. And one of the most intense ones is a crisis. So we tend to like changing macro themes, whether it's monetary policy, issues with energy markets, like I mentioned in 2014, anything that's change we like. Things that are shocks and then everything is good is a harder environment. And that's this year in a nutshell.
If you could add a chapter to the book, would there be any new learnings, any new ideas? You do second edition one of these days. Would there be anything would it be the papers you just wrote, or what would you be adding to it?
That's a really good question. I mean, I think a random fact, as I've talked with Alex Grazerman several times about this, you may not know, but his son is on the PGA Tour. So if you like golf, that's pretty cool. We've talked about it. And I think the things that I've really appreciated just better understanding these extreme shocks and sell-off days is something that I've done a lot of research on. We wrote a paper called Tackling Turbulence and Understanding sort of these cross-asset sell-off periods and why those are difficult for managed futures. That's something that we all kind of know well in the space. Things like SVB, things like Liberation Day. I think I would add a chapter on that. And also just the expansion of the space, like ETFs and like portable alpha and like all these cool ways that you can utilize the strategy, in different packaging and different methods. I think that is also a big change.
I mean, a different way to say it. I remember this reminds me, I don't know if you've ever heard it. Ed Sakota has a great video on YouTube. He calls it the Whipsaw song. Have you ever seen this video?
No, I'm going to have to watch that.
You get a whip and I get a saw, honey. You get a whip and I get a saw, babe. You get a whip and I get a saw. One good trend pays for them all, honey trader, baby mine.
But he has a entire folk song that he wrote about trading whipsaws for a trend follower, which it feels like turbulence, as kind of things go a little bouncy. It's not surprising that the trend strategy might be offsides or on the wrong foot during some of those periods or get whipped back and forth.
I might have to download that and listen to it on my next big turbulence day just to kind of get a good laugh from it because it's not a fun environment.
It's a catchy song.
You get a whip and I get a saw, honey. You get a whip and I get a saw, babe. You get a whip and I get a saw. One good trend pays for them all, honey trader, baby mine.
There's been increasing access to managed futures type of strategies to, I feel like, the broad retail world since we last spoke. More and more, there's ETFs and all sorts of new ideas and structures. How do you perceive the interest level in the community to be for this part of the world? Is it waning, more interested, curious? How do you perceive it?
So I think, what's exciting is, and we wrote an interesting paper about this as well, talking about sort of the managed futures ecosystem and the rise of the managed futures ETF. And the reason that's so fascinating to me is if you learn a little bit about how regulation changed to make active ETFs much more of a feasible option. And since then, you've seen an explosion in opportunities and different launches of ETFs. And if you look at a strategy like managed futures, it is the easiest type of strategy to put in that type of wrapper because it's very liquid. It has very sort of, effective collateral in the sense that you don't need a lot of margin. You can also earn T-bill rates on cash. And, as you've seen, you can also do things like combine equity with the strategy in a very collateral efficient way. And we actually highlight this in the paper that right now is sort of this phase of innovation where lots of new products and this same exact thing happened when 40 Act mutual funds opened up for managed futures as well. You see this early phase where there's like everybody's just innovating and creating different solutions and ideas. And then, as you look over time, the products in the mutual fund space have been much more standardized and the correlation across them became lower. So there became sort of convergence towards what is the market need and what products make sense for clients. So I'm excited to see, there's such a wide range. There's products that have just commodities and currencies. There's products that have equities plus managed futures. So I think it's an exciting time. And I think active ETFs, they're just a natural vehicle for something that's very, very liquid. And their usage, I think, is going to expand over the next decade for sure.
I like listening to you because I catch myself we're peas in a pod here, Katie, where I'm always like, so I wrote this paper. This is like a reference to like, here's this thought I had, wrote this paper. What else have you been writing about that we haven't covered so far today? You got a lot up there kicking around in the brain. What are you thinking about?
I've written a bunch of papers this year, so I'll just give you a couple of them because there's quite a different ones. I wrote one on managed futures replication, which is really interesting, but very nerdy. And that talks about how can you effectively replicate these type of strategies, and what kind of tracking error can you think about, and what methods make sense, and what are the pros and cons? That's a nerdy one.
Tell us a little bit about the replication. Are you generally positive on it? Are there better ways to do it? How do you think about it in general?
Our firm has had a long history of replication, and a lot of the original research was done through AlphaSimplex as well. And my view on replication is it's a method for getting a beta-like exposure to a particular strategy return that can be robust over periods of time. And I think what this paper was really trying to get at is simple replication is actually improved by using priors and incorporating industry expertise. So what do I mean by that? I'm just saying, like, I believe that replication is also a little bit of an art, and that replication can give you the general views of the industry and what CTAs, for example, are doing, but you also need to incorporate priors and risk management and ideas from the CTA world to manage that process. And so that's kind of a little bit of what this paper was demonstrating, because let's just give you a thought experiment, right? So if you're a CTA and you're running a trend system, you have your own art and approach to how you're going to trade that system. Although you're aware of what other people are doing, you're not sort of keeping an eye to be similar to them, right? Whereas replication has a very different view. It says, we're going to do CTA-like stuff, but we're going to be aware of, like, if most people are long gold, then the strategy is going to be long gold, right? And replication can be helpful if someone's looking for something index-like that provides a beta-like exposure to an industry where they maybe don't want to make a decision, like, I'm going to pick manager A and not manager D. It's a solution that gives you something that's CTA-like that is a little bit geared more to be in the middle. But as you know, volatility is high. Slippage across different managers is still high, but you can reduce some of that tracking error more than you might have with any one individual strategy, if that makes sense.
And so as a conclusion, just go buy half a dozen of these. What was the conclusion of the paper? And you should go replicate or not?
So the conclusion was, that a more hybrid approach of kind of using what we call informed replication. So a method of, like, being aware of other CTA returns and what they're doing, combined with sort of risk management and priors for trend systems or trend strategies, gives you lower tracking error compared to a typical index. So if you're looking for something beta-like, it's not just sort of a vanilla replication, because replication has, some issues, right? It's slow because it's looking at the past, whereas active trading is much more sort of updating to where we are today. So by combining those two methods, you can actually smooth out and reduce some of the slippage to a traditional index or a group of managers that you're trying to replicate by combining those techniques.
The older I get, the less I'm optimizing on best possible outcome, though I think that's still a noble pursuit, and more optimizing on what is going to be the most survivable outcome for the investor.
There's a fund of funds called Efficient Capital, and they've written a bunch of really interesting papers about this. And, obviously they're experts in this. And what I love is they have some very nice research that looks at, kind of top performers and bottom performers in CTAs, and there's no sort of significant pattern. So, for example, picking the best fund doesn't continue. So what you're better off doing is sort of picking reasonable funds that make sense, sticking with it, and diversifying if you can to reduce some of the dispersion. But in general, I think the challenge is when you do have line item risk and you see that one fund is down, there is a higher probability that someone might use that criteria you suggested, like recent performance, and then sell, when over longer term, there tends to be a recovery. So, it's really that rebalancing idea that actually makes sense. If you focus on a rebalance metric, things that are down, you rebalance. Things that you have done really well in, you take profit, probably actually do much better, especially for managed futures, which is very cyclical.
As you think about where we are in 2025, do we have a Katy AI yet? Have you started to implement any sort of new frontier ideas on what y'all do in your money management process?
I mean, we've definitely been long users of machine learning. AI is still sort of an open question, and I think it's used more for now as a tool. So, for example, summarizing things or doing different interesting tasks. But I'm very excited to see the type of things it can do for us in asset management, maybe replacing some of the roles of an analyst or writing the code for you or really cool things. We're not there yet, but those possibilities are there. So I think it's going to be exciting, to see how that evolves. I mean, I think for an industry like ours where repetibility of process is still very important, it's about finding those other areas where it might be useful to facilitate processes in what we do.
Well, Katy, look, this has been a blast as always. I love chatting with you. Next time something interesting happens in managed futures, let's get on the horn. And I look forward to us in whether it's a few months, few years, talking about how magically managed futures has done and trend has come back from like a phoenix rising from the ashes of 2025 Q2. It's already doing better. So looking forward to that period, hopefully sooner than later.
Hopefully. Yeah.
Best place for people to find your writing, where do they go?
On our website, I have all of our papers up there for distribution, and I always writing a lot of interesting, like whatever is topical and interesting to me in the managed future space.
And what is the website?
AlphaSimplex.com.
Yeah, we'll put in the show notes links, listeners, all the papers we talked about today, Katy's book, all that sort of good stuff. Katy, thanks so much for joining us today.
Thanks for having me.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.